We're Compound Everything. We talk money, markets, and investing. And today we are talking about a Canadian investor named Jason Donville.
Yeah, so I'm not sure how he came on our radar. I think
From the
through a book.
Market Masters.
Market Masters. His name always stuck with me because of one line in the book, which I probably shouldn't mention.
Yeah.
It had to do with a
Yeah,
cursive.
because we say that all the time. We actually quote that line.
And so his name stuck. But he's actually a very good asset manager. His returns have been 12.1% annualized since inception of his fund, which is called Donville Kent Asset Managers. And he runs out of Toronto, Canada. And so essentially, if you had given him money in 2008, since the inception of his fund, he would have 6x your money. So grown it to 6 times your money.
Yeah, so that's a very
impressive.
impressive.
Pretty good return. And he's actually outpaced the S&P 500 by not a huge margin, but a narrow margin after fees. And
That's important. After fees.
After fees, yeah. And so we're going to talk about this a little later, but at one point, the reason he's underperformed, I wouldn't say underperformed, but he hasn't performed as strongly as in the past is because there was a significant drawdown year,
yes.
which I'm not entirely sure why that happened. I think it has to do with his heavy tech investment, but either way, still a great asset manager, and we'll talk about him today.
Yeah, and we were interested in his performance because we've recently been looking into the performance of some well-known investors, and and we're going are they actually even beating the market? Because we just assume that they are if they're on podcasts and people are talking about them. And I was looking at one particular investor who we follow, and I was looking at the portfolio and thinking, has this beaten the market? Just knowing the companies that we're in. So I did a little head-to-head from the inception of that particular person's fund.
Yep.
And after fees, you would not have beat the market with that manager. And so Donville has beaten the market even after fees. So that's pretty impressive.
Yeah, that's very impressive. So one thing to know about Jason Donville is he runs the fund with a business partner of his who he met in 2011 off of LinkedIn, apparently. His name is Jesse Gamble. So I came across a quote by Jason Donville that I really like because of what we do together. And he said, "The perfect size of an investment team is 2. If you get too many voices in there, you end up with mediocrity because everybody's ideas cancel each other out." So I just thought that really encouraging. That
there's
a pair of them and they run the fund together, and with a team, of course, of people behind the scenes. But I think the majority of the picks are them too.
Yeah, and you see a lot of duos in investing.
Yeah.
The only thing is I feel like sometimes when you're married, maybe the advantage isn't as much of an advantage because we're a little more harsh with... For sure, I'm way more harsh with you.
It could be a good thing or a bad thing.
Than I would be with someone I wasn't married. I'm that's the stupidest idea I've ever heard of.
Having said that, we each have to eat each other's cooking.
That's true. That's true. So let's talk about what type of investing DKAM does and what type of companies they're looking for and how they find their companies and metrics they use because we're studying them.
Yeah.
We want to beat the market.
So one of the things to understand about them is there's not a lot of information out there about them aside from what they put on their website.
Yes.
So
and a few interviews.
There's a few interviews and whatnot. But a great resource that they have is something called the ROE Reporter, which outlines a number of their past investments. And they've published something like 60 of these, I guess, since the inception of the fund. So around 2008 or whatnot.
And they're fast to read.
They're very quick to read. And they give a very good synopsis of what they're thinking in terms of the companies they're buying. They'll talk about macroeconomic factors and stuff like that. They're very educational. So it's a very Buffett-esque kind of a thing that Donville's doing in terms of, and Gamble. I think they write it together now. But it's a very Buffett-esque thing to do is to provide this kind of education to their investors. And they just put it out there for free, which is quite nice.
The nice thing about their ROE Reporter is that you get a lot of letters and reports from American fund managers.
Yeah.
There aren't so many on the Canadian side, so it is nice to have the ROE Reporter because one, if you are not in Canada and you want to enter into the Canadian markets, it's a good way to learn a little bit about our macro and the companies that we have because our macro is different than America. It doesn't always go in lockstep.
No.
We're a different country. And then if you are in Canada, and we have a lot of positions in Canada because we live here, it brings us new ideas and we can even see some of the companies that they're invested in because we live here and one company that they are in, and you went in quite a while back is Go Easy. So we like to always read, and we can see it. We can see them like popping up here.
And that turned out really well for us. And so one of the things to understand about Donville Kent in terms of the way they manage money is they have been primarily fishing in Canadian waters, so to speak.
Which is why we like it.
Which is why we like it. The reason they fish here primarily is because they perceive there's more inefficiencies in the Canadian market as opposed to the American market. Probably just being smaller or less analyst attention and whatnot.
Canada gets very little attention on the international stage. If you listen to investors speak, and I've noticed this, we listen to a lot of podcasts, and I've noticed this in a lot of interviews with big investors. They will mention the UK. They will mention, obviously, America. They will mention Australia once in a while.
Obviously.
Japan, Very few investors mention Canada. Very few. It's hard. We're just like, this little piddly market that no one wants to go into. So it does bring more inefficiencies, and it makes it a little more exciting because you have an opportunity because the eyeballs aren't there yet. And then all of a sudden, a company in Canada will do really well.
Yeah.
And then you get all these big guys looking at it going, whoa. But the overall market, you can find some real gems before the eyeballs start watching it.
That's right. So their optimal zone for investing is somewhere between the $100 million and $4 billion market cap. And the reasoning for that is A, because of the inefficiencies that exist around that area. But also B, they're looking for companies that can compound with a long runway. So these guys look to invest for the long term. Yeah,
their website says that they are compounders. They're looking for long compounders with great ROE.
Yeah.
Hence the name of the paper they write, ROE report.
Yeah. Now, just to give a shout out for one of their investments that they've done, they actually invested in Constellation Software, and they've held it since the investment, but they made that investment around 2008.
I think they said they started buying it when it was $20 a share.
It was $20 a share, and as of, I think, most recently I saw it was over $4,000. So $20,000 to $4,000, and I think they've held the stock the entire way along. And so from that standpoint, that is no longer within their optimal stock criteria, but they've let it run because the economics and the business keeps doing what it should.
Yeah, and one of the reasons they like to fish in that area and look in that area is because I don't know which one of them said this. They said, what's better than a high ROE company is a company that's going to become a high ROE company.
That's right.
And so they like to kind of watch these companies and then get in before they really get all those people. Because as soon as a company has consistent high ROE,
everyone notices.
The inefficiency goes away because everyone notices it and everyone comes up and now it's priced fairly. So they're trying to find it before everyone notices. And that's exactly what they did with Constellation.
That's right. So just to illustrate this, one of the things that I found in a quote by him was, he says, "We're looking at the bottom 500 smallest companies on a fairly regular basis and looking for the 4 to 5 gems among those." So this is where they're kind of spending most of their time, I think. Now, they do have, again, larger plays like Constellation Software, but it's really just grown into that for them. It's not like they would go looking for that, I don't think, at this point.
Yeah.
Having said that, though, reading some of their older ROE reporters, I do wonder whether they've changed their investing style a little bit, because I did remember seeing maybe some larger names, and maybe I'm just making that up.
Well, I would think anyone who beats the market like they have, I would think you almost have to pivot here and there. You can't just be static. I mean, Buffett is like one of the greatest investors, and he has definitely changed his style over the years. Pabrai has he's admitted that he's changed his style. So I think to beat the market, you have to be willing to change your style here.
Yeah,
at least tweak it a little bit.
You want to beat the index, you can't buy everything that's in the index.
Yeah,
or else you just index
it. And then you're just giving yourself a lot of homework for no reason. You just buy the SPY
you're
or whatever.
You're a closet indexer,
yeah.
Right? So if you go to their website, the other thing that you'll notice is that's one of the things they pride themselves on, in a sense, is they'll give you comparisons of what they own versus what's in the various indexes. And there's very little, if any, overlap. And the reason being is because they realize that if they want to do better than the index, they can't just buy what's in the index.
And a lot of people, and they say that's the one thing that happens with funds when they get too big. They can't get into these smaller companies. And so then they do end up buying all these big companies, which everyone else is buying, all the other funds are buying. Those are the companies in the index already.
Yeah.
And so they just end up indexing, like you said, a closet indexer.
Closet indexer. Having said that, I think there is a strategy which could involve buying potentially mispriced names in the S&P 500, but that gets to
Or
be a
beaten
little bit
down.
more, or beaten down. So for instance, Meta has worked out extraordinarily well for us, and it was beaten down. And so I think from that standpoint, though, they do want to go fishing in areas where there's more inefficiency and less people watching. A lot of their stocks, they say, have very little, if any, analyst coverage. And that's one of the things that they look for. So from that standpoint, they can develop their own market hypothesis around it. Maybe also it filters out noise. So if you start to think about what we said about in our prior video about John Templeton, one of the things that improved his returns was actually moving away from Wall Street. He moved to Barbados, and his performance, did very well. So maybe for them, one of the other reasons they're doing better is, yes, because it's small cap, but also because it can filter out noise. They can develop their hypotheses and test them and whatnot.
And one of the ways they get their information, and this was quite intriguing to me, is that they talk to management, and they talk to management a lot. And I have such conflicting views in my own mind about how I feel about management, because the one part of my brain says that is exactly how you should do it. You should be assessing management and looking at management because management's important, which they really do. There was one company, I can't remember which one, they said they talked to management over 20 times before they took a position, which obviously you and I can't really do because our positions are so small they could care less to talk to us. But then the other part of my brain says CEOs are salesmen, and I see that all the time, and management just is trying to sell you their company. And I think it's Peter Lynch who says he doesn't like talking to management because he finds that they can persuade him because they're really good at selling their ideas. That's how they got to the position that they're in. And I feel for myself that I would be that type of person who meets someone and then they sell it to me, and it's a horrible company, but I'm like, oh man, the management just seems so nice, and they seem like everything they said is going to come true, and they're probably 100% honest, and I would buy that up. So I'm just so conflicted on if for me personally, if putting a lot of stock into what the management says, I would prefer to look at the numbers and then see okay, these numbers mean the management is good.
I think we can summarize that and say that maybe talking to management is good for some and not good for others. So, for instance, Walter Schloss and his son, they never talked to management. They, in fact, went out of their way not to. And so, from that standpoint, I think you can still have a good track record doing either or, but you got to find what fits. Mm-hmm. Just know yourself.
Right. And also know, are you, I'm good with people. I can be friends with people, but I'm, bad with people because I can't tell when they're, being honest with me or not. Yeah.
Well, and that's where if you were to talk to management, perhaps, just watching body language and things like that could get your spidey senses tingling as to whether or not this is a good person or a person maybe not to be trusted and whatnot. Now, the advantage of talking to management is, one, you get to understand the mechanics of the business a little bit more. But two, if you're looking at technology companies and whatnot, perhaps the CEO can explain it a little bit better to you if you're not maybe very familiar.
Imagine being able to meet the management of Pado Exploration. Mm-hmm. Back, I think the CEO did retire.
He did retire,
year or two ago.
Yeah.
But he used to write at length.
He'd write a monthly report.
And you could read it. It was on natural gas and not know anything about the industry. And if you read 3 or 4 reports,
you were wiser.
You were way wiser. And he just loved, he did that for his shareholders. He had a love of the business, and he had a love of sharing that with the shareholder, and he wanted the shareholder to be as excited about natural gas as he was about natural gas. And just compare and contrast that CEO to the CEO of Intel, and there's quite a difference. And maybe with Donville and his partner, that they've talked to so much management that they can spot that out.
I think your BS meter, so to speak, will probably fly off the radar in certain circumstances, and that may be what
better and better at it.
And the interesting thing, maybe we should delve into a little bit about their investment process at this point. But one of the things that they do, one of the final steps that they actually do, is go and talk to management, and that's actually one of their criteria for selling. Is what Donville has mentioned before, is if they don't feel they can any longer trust the management, then they will get out of that.
If they can no longer trust management, I was interested in knowing what that means. How do I know I can know? Because let's be honest, every CEO, every CFO is going to make a mistake.
Of course.
So mistakes don't mean that you can't trust them.
Mistakes are forgivable.
Right. Mistakes are no one's going to have a perfect track record, right? But the one thing they said was when the CEOs interests are for themselves and not for the shareholder.
Right.
And I was like, okay, I'm going to be watching for that. I don't have nearly as much experience dealing with management. I have no experience dealing with management.
Of course.
But reading what they say. So I have to really polish that BS meter for myself.
Well, I mean, mistakes are forgivable. Dishonesty is not. You can understand when the management may be performing some shenanigans.
And they must be really, like I said, they've been doing this long enough, because what you don't want is to not be able to realize a dishonest manager when you're at the stage that Intel's at. You want to find it before it gets there.
Yeah.
But you have to really be in tune with what that looks like. So they must have a really great way to read that, and they must know the right questions to ask. And then they probably look at the numbers and be like, okay, are these numbers lining up with what this guy or girl is saying?
So let's talk a little bit about what they look for. What's their secret sauce, so to speak. The first thing first, they're looking for consistently increasing revenues. So as long as the top line is increasing, they're also looking for a return on equity of over 20%.
That's a high return. That's a high bar.
They said the one thing better than a return on equity over 20% is soon to be a return on equity of over 20%. Consistently. So they're looking for companies that are doing that on an early basis, and maybe even companies that don't have that return on equity just yet, but that they're going to get there. And one of the ways they actually do that, they said it's not as easy as just going to do a couple numbers on the calculator. They actually go back and deconstruct a lot of the financials that the company provides and redo them themselves, and then end up with what they think is an appropriate number for that.
They don't look at the stated ROE. They look at what they call the real ROE. And the reason for that is they said financial accounting now makes it very difficult. You can't just pull up something on Morningstar or Value Line anymore, because what they state can be very different to what they're actually doing. So it sounds like it takes a lot of work for what they do.
I think so. And then they speak of proprietary kind of algorithms that they use to rank stocks and whatnot into like an investable universe. And then after that, they'll go talk to management. And well, actually, before that, they'll go look into the qualitative factors themselves. So they've examined the quantitative, so they let the numbers speak for them. And then they'll go look at the qualitative. So the numbers have to be there first, I think, in terms of my understanding of it.
That's how we do it.
I would say that's how we do it too. So the numbers have to be there. Although we've gone the other way.
Not.
I would say we've gone the other way before, and it hasn't worked out so well.
I was going to say, no, I think you're running.
That's probably the way it should go.
I'm like, no, I've definitely gone the opposite direction.
Yeah. In the end, what they end up doing then is they look at the numbers first. They look and if the numbers look intriguing, then they'll go look into the qualitative aspects of the business, learn more about it. And then after that, they'll go and talk to management. And then once that is done and once they're happy with that, then they'll potentially take a position and look at sizing it in the portfolio.
And they did say at one point that when they take a position, they generally take a small position, a smaller position. I guess it probably depends on the company.
Sure.
And then they kind of watch to see is what management's saying actually happening. And if it is, that's when they really start to build up their positions.
Yeah. Just to continue on portfolio management, one of the things they do is tend to concentrate, is my understanding. On their own admission, their top 10 holdings will represent about 75% of their portfolio. So they're quite concentrated. They make big bets. And I think you have to really do that in order to outperform the market, generally speaking. Having said that, some people have done it with more diversified holdings, and I'm not sure how. Peter Lynch is one of them.
Yeah, one thing they say along that line is that in a podcast I listened to with them, they said if you are a really good stock picker, then you should not diversify. They said if you are good at picking stocks, do not diversify.
Yeah, why would you spread your best ideas all over the place?
But if you're bad at it, index.
Yeah.
That stuck with me, and I was like, and then I'm going through all my positions. I'm like, am I a good stock picker? Should I just save myself the headache and just put it in the SPY?
Now, one of the things I did notice about them, just based on reading the ROE Reporter, is I think they're actually pretty quick to change their minds if a business doesn't start to go the right way, let's say. Now, one of the investments that they made, they actually developed quite a compelling argument for. I read it.
We were looking into this particular company around when they wrote about it.
So it's a company called Reitmans.
And we were like, what?
A Canadian clothing company, and they run a few stores with different names. So there was RW & Co., there's Reitmans, and one or two others I can't remember. And they developed quite a thesis of, investable thesis on Reitmans, and I think they took a reasonable position in there. And so they had mentioned Reitmans for a few of these ROE reporters, and then all of a sudden dropped. So I don't know, and the stock went nowhere, absolutely nowhere since the recommendation.
If you knew anything about fashion,
yeah,
you would have been like, I don't care.
Yeah.
Like how on sale it is. I don't care what the management says.
The fact that it's still in business.
Nobody. Like, that's the thing. We pass Reitmans. I'm like, who the heck shops there? Like,
yeah.
As a woman, like, no. And then, like, maybe RW and Co. Some. But
yeah,
not a lot.
So for the past 2 years or whenever they started to bring up the position, that stock has went absolutely nowhere. Now, they do pay a very high dividend, but I think they've slashed it.
Well, and the thing is that I was kind of like, oh, I wonder why. And maybe we'll contact them because he says, oh, contact us.
Yeah.
They never talk about Reitmans again.
No, and it just kind of dropped. So I assume it's no longer in the fund.
But I wish that he would mention, like, what made them change their mind or why don't they talk about it anymore? Because they did a very extensive...
Yeah, it was compelling. I have to say it was compelling. Now, one of the things in retrospect that they did say in that write-up is they were talking about normalized PE ratios for competitor clothing stores, and Reitmans, I think, was trading at a single-digit PEs, but all the other competitors...
Like value.
So it looked like value, and all the other competitors were trading at PEs of like between 15 and 25. Aritzia being at the high end at 25.
Well, I'm sure Lulu at that point was probably like 50 or something crazy like that.
Yeah, but anyone who's in a mall would be able to see that Aritzia was far busier than Reitmans or RW and Co. Like, it was hands down, no question. They were not the same businesses.
Well, and that's interesting because we talked about that statement that they made about how their PE is low, and once they normalize, their PE is going to go back to the industry average.
Yeah.
But you and I were talking, and we did talk about Reitmans around this time, and we are actually talking about it further too, and we were laughing because we're like, it's never going to go.
No.
And this was like before we actually read their report on Reitmans, and we were just like, it's never going to go back to the industry average.
No.
Because it's a dead company. And
it's
I remember
dying brand.
Yeah, and with retail, and particularly with clothing and brands like that, like makeup, things like you have to be really cognizant of what the consumer likes because trends change like that.
Yeah.
And even though the industry average might be something, if that particular company or trend falls out of favor, it is hard for them to come back.
Very.
And there's no way that Reitmans could have ever been compared to the industry average because it wasn't Lulu, it wasn't Aritzia, it wasn't any of these other stores.
There's nothing to differentiate that brand versus H&M or Zara or any of those other competitors that have now come in. It's a different competitive landscape now in Canada than it was before for clothing retail.
Well, and for that
Forever 21.
It's not even that it's a different competitive landscape for retail. The landscape is still the same. That company just sucked. And if you just knew one thing about fashion, you knew it wasn't coming back.
No. So you can't attribute a higher multiple to it. It will never have that multiple expansion. I shouldn't say never, but it is very unlikely that it'll experience that multiple expansion because of increasing in growth in sales and whatnot.
Right.
If you went to the mall, you'd see it wasn't happening.
You say if you go to the mall, and I say like if you were just a female.
Sure.
And here's the thing. I don't want to like rag on them because they're better investors than we are. But that one just was interesting to me because I was like, if they had just like talked to an average female, they probably could have said like. No.
But interesting lesson though is if you read what they say on their website and through various other ROE reports of what they look for in a business, it didn't fit.
Yeah, so I wonder what the thinking was.
Yeah,
there.
it was not a company that had readily increasing revenues. It was not one that had a definitive competitive advantage. It was not one that had an ROE of 20 or more. So the only thing that made it compelling, I think, was its cheapness. Yeah. But it was cheap for a reason.
Oh, it was cheap for a reason. And it's one of the funniest things about Reitmans in my mind when we were sitting there talking. I think it was with Phil that we were talking about Reitmans with. I remember like looking at their management and their board and being like, they're all like old. And I remember, and I'm like, I feel like I'm already old and they were like years beyond me. And I'm like, what do these guys and men, I was like, what do these guys know about women's fashion? And it's like a lot of men know about women's fashion, but just looking at their picture, okay, I was totally judging a book, but I was looking at them when like, these guys don't have a hot clue about women's fashion.
So in the end, I wonder if they would have counted that as a mistake or they're still waiting for it to play out. But things may still play through. I don't know. But
I kind of want to talk
I have very limited expectations of that business.
I want to talk to Jason and be like, what did the management say?
Yeah.
Because I totally made a judgment call just on the way they look. Like, did they sell a story? Do they actually understand? I don't know.
Yeah.
Yeah.
So Let's talk about another investment of theirs that you particularly love, and it's done well for us as well. I'm not sure if we came about this one through reading his ROE Reporter, or
No.
we came about it on our own. I can't remember. But that's Hammond Power Solutions.
Yes. So actually, I came across Hammond Power Solutions from a forum, an investing forum. They were talking about the electrification of everything, and there was a side note talking about a small Canadian company who makes transformers. And
so as soon as you read that, your radar's up. Oh, Canadian company.
yeah, well, I saw a Canadian company, and then it had to do with electricity, so I was like, okay, I got to check this company out. It was a little while back, and it's been a very good position for me.
Yeah.
So I don't know anything about transformers, so instantly I should have probably put that in the too hard box, because to be honest, I didn't want to learn. But my dad is an electrical engineer, and so I thought, I'm just going to text him. I'm just going to throw him a text. And my dad doesn't always get back to my text like right away. So you have to like know the backstory to that. So I text him and I said, what do you think of Hammond Power Solutions? And like literally 10 seconds, he's like, they're the best in the business. And that was all I needed to know.
Yeah.
So at that point, now I'm doing the opposite of what Donville does, because I knew about the company and then I looked at the numbers. Then I started looking in the numbers. Then I did a deep dive in transformers. And then eventually I actually did find myself learning more and more about that industry. And that was it. And the rest is history. And I've added on the way up, and it's been fantastic. And I wish that it would have a huge drop so that I could put more in.
It tends to be somewhat volatile, so you might get that chance.
Yeah. Oh, it's very volatile. Yeah.
And I bought on the way up as well, much after you did, but still, it's turned out to be a good position. Now, this is an interesting company from a business perspective, because it's not a new company. It's a company that's been around for ages. And they've been making transformers forever. But the industry kind of almost fell into their lap in a sense.
And they talk about that. So before we go down there, let's just say, like, one thing they said is that there will be industries that aren't investable, and then all of a sudden they become investable. And Hammond was one. So continue.
So Hammond wouldn't necessarily, if you had invested in it, 10, 15 years ago, would not have been a company that would have had compelling, story, or even, I'm not even sure they would have had compelling revenue growth. I don't recall. I think we did look at the revenue. I don't think it was spectacular in the past, like in terms of growth. But all of a sudden now,
and the stock price shows that, because the stock price is
it was pretty flat for years and years. And then all of a sudden it looks like up and to the right. Mm-hmm. The industry really fell onto their lap with the whole electrification of electric vehicles. People becoming more affluent in terms of requiring things like air conditioning, and
middle class growing
in other countries.
Because they are in India, they're in Mexico.
Sure. So their reach is expanding. So the total addressable market all of a sudden it went from here to way up here. A company that is well positioned there in a opportunistic sense, and just basically gets handed a streak of good luck, can actually make a very good investment.
Yeah, and I will say, if it wasn't for my dad, I would not have put money in to it. But when he texted back and said they are the best in the industry, and then he gave me a lengthy thing about them, I was like, okay.
Yeah.
Like that was the catalyst I needed, combined with knowing that we're going into more and more clean energy, for me to really dive in and be like, do I want to be in this company? Now, we weren't really following Donville much at that time. We knew about him. But then when I found out that he was in it a little while ago,
that piqued your interest.
Made me even more happy.
Yeah.
Yeah.
Now, along that vein, Hammond Power is one of those companies that actually still has a significant family ownership and control. I think one of the family members is the CEO, if I'm not mistaken. And that's one of the other things that Donville has mentioned in the past that they like. They like significant insider ownership, and they actually like founder owners and whatnot.
He's not a founder unless he's like over 100
No,
years
he's
old.
not. But I'm speaking in generalizations there. So they like it if the founder's still involved somehow, or if there's significant insider ownership.
Yeah.
So that's the other thing.
Everyone likes a founder CEO, and that's the problem. That's why it's hard. You got to get in those companies, like what they said, before it becomes when you can kind of be like, I think there's good reason to believe, between the management and the numbers, that this company is going to become a compounder. Yeah.
Well, I mean, if you really think about it, who's going to work harder for that company than the CEO who founded it? Mm-hmm. Next to them, well, is the family who's been handed down the company. Well, you would hope, because that's their source of livelihood.
Yeah, and also we've actually listened to other investors who hate families that are involved in companies. So it's quite interesting to me that DKAM likes when families are still interested and invested, because other investors are like, we don't like that, because they have, as a family, you have your family at heart, not the shareholders.
Well, and oftentimes there comes with different voting interests and things like that,
and then
so
you
it gets
family
messy.
Beef.
Yeah,
there's always family beef. Like family beef can be like,
well, Rogers.
Yes, there was family beef and
Rogers.
That's right.
Yeah, that was a whole issue around. There was beef with Rogers' family all around the time of the Shaw acquisition.
Yeah,
which was fascinating.
Yeah, and that actually it did plummet their stock when that family beef.
They started fighting, and oh boy.
Yeah. So, but whatever. It's like everyone has their own thing. So total side note, but one thing that they said is that they tend to be more optimistic about the market in the long view, that the market over the long view has, in bull markets, returned more money than bear markets have lost. Of course, this is like really zooming out. And they talk about like perma bears. They don't call them that, but people who are like overly like bearish. And they just say they don't make as good returns because the market, like the world is getting better. Yeah. Technology is pushing us forward. The middle class is growing. And I know you go on social media and you watch elections and you do this and you do that, and everyone thinks, it doesn't matter who you are, what your political views are, everyone thinks the world's getting worse. But when you just take a minute to think about what we have compared to what our grandparents had, and what our grandparents had compared to what their grandparents had, the world is getting better. Right? And so I like that because I was a perma bear for a long time, and I changed my view maybe 5 years ago, maybe 3 years ago. And it's been probably one of the best pivots I've made in my investing journey is to be way more bullish and way more optimistic about the future.
I think you have to be an open-eyed optimist. You can't be a starry-eyed optimist and not see any potential hurdles, but an open-eyed optimist.
I'm not quite Kathy Wood yet. Like
sure.
I'm not quite that bullish yet, but I'm definitely not bearish like I used to be.
Yeah.
So I think that covers a lot on DKAM and on Jason Donville and his philosophies of investing. But why don't you wrap up with some points?
So let's just kind of summarize what they look for in a business. So they're looking for small cap to mid cap at largest. I think they fish in small waters. They're looking for companies that have a consistently generated improving revenues over time. And they're also looking for companies with high returns on equity or soon to be high returns on equity. And they also look to talk to management, and they look to invest with people they know they can trust. So it sounds a lot like Buffett there, right? So
a lot like of it. Buffett. And they have he likes two people.
Yeah, and right? So there's the whole
they eat their own cooking. They're invested in the fund, which is important.
A substantial amount of their own money is in the fund. And they look to invest for a long time horizon. And so they look to invest for a minimum of 5 to 10 years, generally, I think is what they said they look for. And I'm going to close with a quote. This is on their website. This is a quote from Buffett. It says, "If you're not willing to own a stock for 10 years, don't think about owning it for 10 minutes.
Yeah, and with that, I think that's a good quote to end with. Thank you for watching our video. If you want to learn more about Jason Donville, like you said, you can find their ROE reporter on their website. It's a quick Google search. And if you can like and subscribe this video, that really helps us, and we'll see you next week.